Hi, I'm Peter Rose, founder of Longwood Currency Trading. Is an 80% return on your money in Forex trading a ridiculous statement? Is that a scam statement? Is that even within the realm of possibilities? Yes, it is possible. And more. And I have the math that shows what you need to do in order to do that from a theoretical standpoint. And I myself have been up as much as that in a year. Did I keep the 80%? No. One year I was up pretty close to 80, is about 67% or so going into the fourth quarter. And I ended up the year 10%, or 30, no, it was 30% on that for the year. So I lost 40% of the almost 70% that I had gained. But I still ended up 30% ahead. But I was swinging for the fence. I was trading large multiple lot size positions, and I take the rules that I have, that I teach for conservative trading, that lays the groundwork for swinging for the fence. I take those rules and I have a layer on top of that, my swing for the fence rules, where I push those positions. And I push the positions very heavily when they're there, and when they go against me, I will tend to, unfortunately, hang on to them a little too long, way too long, because the loss then becomes very large, and I get wrapped up into trying to take another run at it, and I drop it again. So there was one year I was up 40%, and then I ended 10%. Next year I was up, like I said, about 67%, and I ended up about 10 or 12% up, I think. And then the next year I was up 84% going into the final quarter of the year, and walked away from that with I think it was 46% return. Now that's really pushing the swing for the fence deal, and the problem was hanging on to that. You know, it was the last trades of the year and the last quarter, and I mean, look, I was up 80%, 84%, so I had plenty of elbow room there, runway, to try to make that next win. That next win would have taken me to 120%. So, you know, you have to balance the trading out. Would you try to do that on a $10,000 account? No. Would you try that if you were trading at 200 to 1, or, God forbid, 500 to 1, like a lot of you are? No, you'll get wiped out in about 15 seconds. But the question is an 80% return possible? Well, there are people out there making 80% returns. There are people out there that are making 200% returns. We see them talking on the videos about what they can do. Some of them are just outright lying to you. And some of them are saying, oh, I'm trading at 500 to 1, and I made a 300% return on my $1,000. I took my $1,000 to $8,000 or something. So you get a $7,000 gain over $1,000 risk, and you're levered up 500 to 1. So it doesn't make any sense. Let me tell you what the rules are for stating your percentage gains and losses, so that you don't fall for somebody's bullshit when they're talking to you. I'm straight up with what I'm telling you. I got a degree in physics, almost a minor in math, 40 years of real estate investment. I think I know what I'm talking about. When we're trading currencies, the first thing is, how much leverage are we going to use? If you're using 100, 200, or 500 to 1 leverage, you're crazy. I can't help you. Don't listen to this video because it will make no sense to you. I use 10 to 1 leverage. If I'm going to trade one full lot of a currency pair, I'm going to put $10,000 against that. So if I'm going to trade 10 full lots, I'm going to have $100,000 behind that. Do I need $10,000 per full lot? No, I don't. Given the current state of pricing in the currency market today and the U.S. requirement for 5% margin against the cash value of the position, in other words, if the position is price is 1.0000, then a one full lot is $100,000 cash position, and so you put up 10%. You pay 10 to 1 on that. You can buy that for $10,000. You're controlling a $100,000 account, and your margin requirement of 5% is $5,000. 5% of $100,000. Okay. Because some of the prices right now are running, well, like pound dollar right now, it could be 1.25 or 1.29, but you can cover that with about $6,500 of margin. So I could trade one full lot for $7,000 if I wanted to. And then if I made $1,000, instead of saying, oh, I made 1% against my $10,000 bank, I could say I made 1% against my $7,000 bank, and my percent return would be greater as a result of skewing the data that way. For risk management purposes, if you're not trading the way I'm outlining for you to trade at 10 to 1, $10,000 for a one full lot, then the numbers that you're coming up with for your returns and calculating how well you trade and all that stuff, you don't know what you're doing. And you're going to get yourself in trouble because you're going to think you're doing better and you're a better trader than you really are. Because it's very easy to skew a 500 to 1 result to astronomical returns, and those returns are meaningless. If you can get a 40% return against my characteristic, my criteria, 40% return against one full lot is $4,000. That's a really good return, 40% against that 10,000. Can you get that? Sure. You have to know what you're doing. You have to understand the math behind it. You have to be skilled. You have to be experienced. You can't be some dumbass throwing shit against the wall at 200 to 1 and using fucking Fibonacci numbers and all the rest of the shit that you see out there. You have to learn how to trade. And in learning how to trade, when you learn from someone like myself, you're going to have to get the fantasies of the 500 to 1 gains out of your mind and say, what kind of gains can I get on a 10 to 1 leverage? I got a $10,000 account. What's a reasonable gain for me? Can I get 80% on that $10,000? Yeah, you can, but not as a beginner with less than 2 years experience, particularly if you're looking for an 80% gain and you're only leveraged 10 to 1. Okay? If you're leveraged 500 to 1, you could make 80% in a month. But when you lose, you're going to end up losing a lot at that leverage. At the leverage that I use, when I really push it, and I was trading lot position sizes, or 20 lots, 200 grand, 25 lots and more, and just managing that, but the same consistent 10 to 1 leverage, and going from an 80% gain, working my way up an 80% gain into that final quarter, and then whoosh, end up with a 46% gain at the end of the year. That 46%, you can say, oh, you lost all that money. Yeah, but I made 46%. Where are you going to make 46% on your money? You're not. Not even in real estate. And I spent 40 years in real estate. So I know a little bit about that. I've lost $1 million twice in my life due to real estate economic collapse. I made the $1 million back each time, but it took me 10 years each time. If I lose $1,000 on my one lot position, how long is it going to take me to make that back? That's a 10% loss. How long is it going to take me to make that back? The currency market will allow you to do that far easier and quicker But you do have to come to the table with a basic understanding of leverage and how it can work for you as well as how it can work against you. Will I trade at leverage greater than 10 to 1? Yep, I'll do that trade of if I got a $6,500 margin requirement, I'll do a trade at $7,000 for a full lot. I can reduce that because that leverage will be used after my position is in profit and I've got lots of runway behind me and a lot of accumulated profits. I can add on to that position. Now I have to be careful about how I add on, because if I have a 4-lot position and I add on 10 more lots, I bring the average position value up very close to the current price. And if I'm now leveraged far higher, man, that's going to be just really hard to beat, right? Regardless of all that, I've done the close to 80%, 68, 80%, 84% returns against my money. I swing for the fence too hard at the wrong time and I stayed at the party too long, and I get hammered for that. And I lost half my account in the last foray into that. And so it can get really dangerous when you hold those positions too long and they go against you. And again, that was just trading at 10 to 1. So it can go badly against you if you make bad decisions. But the leverage is the key issue that you're dealing with. If you're going to play with fire, you're going to get burnt. Even if you don't play with fire leverage and you do the wrong thing at the wrong time, you could still lose all your money. The simple solution is, and there is a very simple solution to what I'm doing, I'm just simply choosing to take that risk because I don't want to lose my position, as Jesse Livermore says, so that because I'm very convicted in the position that I took, I'm going to stay with that position. I'm not going to lose my position by getting out, taking the loss, and then getting back in, taking a small loss or whatever, and then thinking I'm going to get back in, because I can't get back in with the lot size that I went out with. I have to start staging back in, and so I get that amount of money that I made, and then I've got to stage gradually in, so I'm not going to make as much money. But that's okay, because part of the skill of trading is, like Kenny Rogers used to say, you got to know when to hold them and you got to know when to fold them. And leverage plays a great deal with the percentage return against your bank that you're going to be able to achieve. And you have to calculate your percentage return against your percentage not on the bank. In other words, if I have $100,000 but I only trade 10,000 of that, I can't say that I've only made, and I make $2,000. I can't say, well, I only made 2% against my bank. What good did that do? I didn't trade the whole bank. I only traded $10,000 up. So I made 20% against my risk. That's what you have to understand. What are you risking? What do you directly have at risk? I'm willing to take $10,000 with a $6,500 or $6,300 margin, and I'm willing to go through that whole stack if I feel I'm convicted in the correct statement. Now, truth be told, is I'm not going to lose more than that $4,000 buffer between the $10,000 and the $6,000, because then I'm under margin and I can't hold that position anymore. So my risk of ruin is minimized by the capitalization requirements of the position by the U.S. government, which is 5%. And that may be very true in your own country, although most countries outside of the U.S. allow basically no margin and 500 to 1 leverage, and you just have it all running against you. There's no way to determine how well you trade. I talk to people, I don't talk to them, but I email a lot of you guys back and forth, and it's very difficult for me to tell you that you're not as good as you think you are, because you're dealing with the wrong set of metrics. You're dealing with the wrong set of data. And leverage is one of them. How you calculate your returns against your risk is another factor. that you have to get into gear. The second way that large gains like the 80% are possible is by not doing anticipatory trades. Instead of saying, oh shit, this looks great, I'm going to get in right now because it's going to do this. As soon as you say, because I think it's going to do this, you should not be taking that trade. Because if you do, you're anticipating that the price is going to do something. And you can't do that. You have no control over what that price is going to do. And because you're doing an anticipatory trade, you're falling in love with the position. And when it goes against you, you're going to freeze and you're not going to get out. And you'll take a more significant loss than you would if you had just got in later after the position had already moved in the direction that you thought it was supposed to move into. It was solidly established moving in that direction. You take that position, it goes against you for a small amount, and you go and you cut it for a small loss because you know your entry analysis was incorrect. If you do an anticipatory trade, you don't know that it's the entry analysis that's incorrect because you didn't do the correct entry analysis to start with. So if you're not doing anticipatory trades, if you're not involved in that horse shit, then the odds of you being able to make large-sized, oversized percentage returns against your risk are greatly increased. And the third, not requirement, but construct to successful trading to make these outsized percentage return gains is simply getting out of a losing position right away. Now, you can solve the entry problem by setting a short stop, and that'll get you out right away. Because if it goes against you 10 pips, 8 pips, you don't know whether it's going to go to 40 pips against you, or it's going to just do a slight retreat. You don't know. So you get out, because you can always get back in. But if you take a 20 pip loss in your entry, and you do that, if you're a 60-40 trader and you take 20 pip loss 4 times, how are you going to make that up on the 6 that you win? You see, you're not going to be able to do the numbers. The math doesn't work out for you. You can sit down on a piece of paper and write it out. You'll see it doesn't work. So you have to get out in your entry. And what about a position that's running in your favor? You still have to get out, even though it's running in your favor, when certain conditions identified in your rules indicate that you should get out. Well, what are those rules, Peter? Well, I don't know. You'd have to take some consulting from me so I can get to know you and find out where you stand in your ability to trade, judge loss, judge potential gain, what's your win-to-loss ratio, all that sort of stuff, before I could definitively say, hey, here's where I think you probably ought to consider exiting that trade before it gets to that profit target. If you can, if you have the experience to manage those positions so that you don't take a position that's run, say, 20 or 30 pips in your favor, and then you let it come back 20 pips against you, and now you end up with a 5 pip or 8 pip gain instead of maybe a 22 pip gain if you would have got out sooner. You see? So you have to know when to get out when you have a position that's in motion. And that's it. 3 simple things in order to set the stage for you to have the capability of doing what I've done, is to come to the point where you have 70-80% returns against your risk on a reasonably leveraged account. And it doesn't matter whether the account size is $1,000 and you're trading a mini, or $100,000 and you're trading 10 lots. You still have the same criteria. It's easy to calculate that way. So are 80% returns against your Forex risk possible? Yes, they're possible. People are doing that. I have done that. I haven't completed a year where I've been able to hold on to that, because I usually swing for the fence really hard in the final quarter, which is probably not a good idea, because I'm swinging for the fence in a very calm and potentially a crazy reactionary market stance as all the economies of the world are resetting their entire country financial restructure for the first of the year. And so I do it at the wrong time. I swing for the fence at the wrong time. If I just go have a cup of coffee for 3 months and not trade, I'd consistently be up there. This last time that I didn't do that, it really knocked the shit out of me. And so I'm just going to go back and I'm going to have a good time trading, and I'll have very positive reports for y'all. But will they be 80% returns? I'm not really going to be looking for the 80% returns. I'm going to be looking for something totally different, and I'm going to go about it in a totally different way than how I would discuss in videos, because it's a complicated thing to try to discuss. I go over that in great detail with consulting clients and people that are taking a course with me, because I consult. It isn't just a PDF manual that you download, or you go into an online course and you get to see 15 videos and you read some course. You take a course from me, you get my time. That's why I don't have very many students. I don't have any running together a whole lot, and why it's very expensive, because you get my time. If you want to learn how to calculate all this stuff and learn what's reasonable and how to be reasonable in achieving that reasonable, and what you can do to achieve the unreasonable by being reasonable when the time is right. That's what I share in my courses and my consulting. But I can't do that in a video because it's impossible. You don't have the opportunity to ask me the questions that you have that are relevant to what I'm saying to you, the way it impacts you directly. I have to talk generically, and I think you understand that. So if you do have any questions that I could answer for you or help you understand this stuff better, hey, send me an email. I'd be happy to respond to you. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day. And guess what? It's just started to rain. I'm glad I didn't take the bow dog out for a walk because I'd be soaked. But when this blows over, me and the bow dog are out for a walk in the woods.